Let's welcome in that guest. He is Peter Mallouk. He is the founder and CEO of Creative Planning. Chris Grisanti of MAI Capital is on set. And Peter, you and I were sort of retweeting and going back and forth on this, and I appreciate you coming on because we do have to remember that stocks can go down, stocks will go down, and it can be a gut check. But ultimately, I thought we were supposed to buy lower and sell higher. When did we seem to forget that?
Well, first of all, you're one of my favorite follows on X or whatever we happen to be calling it today. But yeah, I mean, the normal is not what we had for the previous 2 years. The chart you showed at the beginning of being up 45% over 2 years. And not only that, but with record low volatility, that is not normal. What is normal is what we're experiencing now, which is a market that doesn't go straight up and big tech stocks actually taking a breather on occasion. Average stock market drop in any given year is about 14% from top to bottom. We didn't even experience that this year yet, probably. And so, look, we're just back to normal where the market will find its way, but it's not going to be a perfect straight line. The reason we get stocks doing better than bonds over the long run is because of the investors willing to pay the price of this volatility. Embrace it.
This is, Chris, a critical, and I would expect nothing less, by the way, from Peter Mallouk. That's a critical point that he's making, which is stocks are more risky than bonds for a reason.
Sure.
They have risk. Theoretically, you are being compensated. In other words, you can have more upside, but you could also have a lot more downside because stocks will not, do not, and should not go up every single day.
Sure. And Brian, but what this conversation is missing is valuation. So where we're entering the play here is valuations are still quite high. They're the second highest in 100 years. Only higher was the internet bubble. So I would say you got to throw that into the mix too, because yeah, they go down. Yeah, they have a drawdown of 14% on average over 100 years, but there's a lot of variation there. So I don't think we're out of the woods, although I do see some comforting signals short term.
What are those signals? And curious kind of how you're positioning more broadly.
Sure. So we got two events in April that are going to make us or break us, basically. You got tariffs and you've got earnings. So if those go the right way, it's like my NCAA bracket. I can find a way to victory if certain things happen, but they have to happen. For number one, the tariffs have to be judiciously applied, not laid out with a big paint roller, but targeted and small enough that the market can shrug them off. The second thing is earnings have to come in. The good thing, Kelly, is that earnings expectations now have come down quite a bit, and folks are not expecting kind of the grand slam of earnings season. If we just meet expectations for the first time in a while, right. I think that's going to be settled.
Oh, fair enough, Peter, but I don't know if we should be surprised that things are going to slow down. If they don't slow down, we have a problem, and I'll tell you why. Number one, we got trillions of dollars of relief thrown at us during COVID. Only a small percentage of that actually went to COVID. A lot of it was just, here's some money, have fun. Interest rates were at the lowest level they ever were. So we're coming off of a market sugar high. I don't, tell me what you think, you're the guest. I don't think we should be that shocked if the consumer slows down from here, because credit card debt is at $1.2 trillion.
Right. I think that there's what the consumer is going to do and their sentiment. I know that we have record negative sentiment came out today, which we haven't seen since 2013. Of course, the stock market's up 400% since then, and consumer sentiment's actually a contrarian indicator. So it actually makes me pretty bullish. But no, if the market was going up 20% a year, that can only happen because of persistent inflation. That's, believe it or not good for the long-term investor, because it speaks to a degradation of the dollar that can create an existential crisis for the United States, create separation between the working class and everybody else. It's problematic. We want there to be growth, but we don't want it to be inflation, all about inflation. We want it to be about earnings, and we want it to be about innovation and things like that. I do think from a valuation perspective, the market, you have to segment the market. Globally, there's a lot of value all over the world, despite the recent run-up overseas. Small cap stocks, a lot of value in small cap stocks. In the S&P 500, you take out the Mag 7, there's still some value there. The Mag 7 is the one that's really gone crazy from a valuation perspective when you look at the markets. But you can even make the argument there, hey, the AI revolution is largely taking place in these 7 stocks. These 7 stocks are bigger than most nations' economies. Big nations with large GDPs, bigger than their economies, you could even make a case that that's somewhat reasonable as well. So I'm just much more bullish over the long run. I never make a prediction over the next couple quarters. Tariffs is obviously going to drive a lot of that, and I'm not overly confident we're going to have pinpoint precision here. We've not really seen evidence of that so far this go round. So I expect some things to be broken along the way.